The last few months have been rewarding for Intellect Design Arena, with the financial technology company bagging 4 big-ticket contracts in the second quarter. The markets have also rewarded this stock, but have these new orders set the bar too high for the company in the coming quarters? Let's ask Arun, Jain, Chairman and Managing Director of the company. But the peg here obviously is not just the business. It's also about how the stock has performed from last Samvat to this Samvat, which has been almost double in terms of a stock price return. Mr. Jain, thanks very much for taking out the time and speaking to us. Obviously, things are going great at the company, and we've seen that in terms of the numbers over the last 5 quarters. We've seen the collections go up, which means alternatively the reduction of the cash burn at your end. What's the outlook for? Will you be able to maintain this performance in the coming few quarters?
Yeah, let me just thank you very much for inviting me for the talk to the investor. I think we are a new company on the block which is focused on financial technology products. So it's a fintech product company which we enable the large banks globally. So in the last 3.5 years of our listing as an independent company and focus on investment of over 1,000 crore into the company, it started delivering the result what we are expected to. Our run rate has moved from 600 crore annually to now 1,500 crore annually. So I think that's a big satisfaction from an Indian product company perspective. We are able to get 62% revenue from advanced market compared to the local market. Most of the Indian companies takes revenue from the domestic market, but 62% share of the revenue is substantially large number, more than what we had initially when we started the company. So I think our studies are working well as of now, and looking at in product business, we have 14 products for the investor. Out of 14 products, 4 products are now at a stage 4 of the development and ready for stage 5. Stage 5 is when partners start selling your products. That is the stage 5 of it. So 4 products reaching the international benchmark where there is a high license revenue. Our license revenue last year, in last 6 months, grown over 86%. Which is again a benchmark and lead indicator for product company, because those are measured by the license revenue. So as of now, things are looking good to grow. We designed the company for 20% growth year on year. We are expecting in dollar terms. We grew 42% in this quarter, but for annualized basis, we designed initially 20% on dollar terms, but because of advantage of rupee, we could be able to get a better returns on the growth numbers. But now, looking at the numbers, we are looking 25% growth in dollar terms will be possible in the current year. And looking at last 3.5 years CAGR, we are growing close to 23% CAGR in last 3 years. And I think these are all the indexes which are working in the right direction right now.
All right, so 25% in terms of dollar revenue growth is what you anticipate. So I want to go back to your previous your answer and talk about the 4 products have reached monetization stage. In the near term, foreseeable future, how many more products do you see, reaching the monetization stage? And also your strategy to start selling more to your existing client base, because that's probably a focus area for a company like yourself.
That's right. So both the levers are available to us. First, the 4 products now which reach monetization stage. We have got 21 lives. They start growing at a faster pace. Their growth rate of these 4 products could go up to above 40% year on year, these 4 products. Then second dimension is every year our focus is to bring 2 more products into the maturity stage of monetization stage. So out of 14 products, next year if you have 6 products to be there, that is the next point. And third is with the existing base of over 200 clients, how do we do the cross-sell? So these are 3 levers available, which gives us a confidence of continuous growth over the next 3 to 4 years. We don't see any shortage of the market space. We may be constrained on the capacity, which we have enhanced last quarter by hiring another 200 additional people, because it takes 6 to 9 months for us to develop specialist people in the product business.
So my point being, if you have to do that, you're currently spending about 25% of your revenues in sales and marketing. If you have to achieve that next level, will this increase considerably?
I think 25% is now stabilized over the period of time. In last 1.5 years, it's getting stabilized at 25%. So 25% sales and marketing is what we are comfortable with, because with our growth in the revenue, this budget will automatically increase.
Mr. Jain, what's the nature of deal wins that you envisage which will help you clock in this 20-25% growth for the next 3 years? Would the deal sizes increase over the course of the next 12 to 18 months?
Yeah, if you observe our license revenue growth in first half year is 162 crore, last quarter is 109 crore in single quarter. I think this license is a critical metrics which we are looking at it. Typically, we used to price our license around $10 lakh to $15 lakh. Now our price band has moved up to $30 lakh to $60 lakh. So I think that's the price band of the license which is driving us the bigger size deals. And second thing is, in the deal itself, our license quantum is 50% of the total deal value, and 50% is implementation. Earlier it used to be 1/3 license and 2/3 implementation. Because of maturity of the product, our implementation comes smaller than the license, and we can get higher money for license, and license gets us a next 10-year benefit, because we have AMC of 20% on the license over the life cycle of the product.
Would this mean higher margins? And do you envisage that over the next 3 years you can progress to the next bucket of operating profit margin bands or EBITDA margin bands? What's the forecast?
Substantially, I think that's the right thing. If you look at FlexCube, Oracle Financial Services, what margin they are enjoying today, over 30-35% margins, are just because of the efforts which they put in 2006, 2007. Because once per company is mature, the margins are in the range of 30%, over 30% in next 3 to 5 years.
So where would you move your margins to, say, in the next 3 years, Mr. Jain?
I will not able to give you the exact number, but I think that's a kind of a number I'm saying. It could be about 20% margins can be definitely be there in next 3 years' time.
Okay. Just one small issue. I mean, we're just looking at a report, and the range of bad debts provision, which historically I believe was about 10 to 20 million per quarter, but in second quarter there was a provision of about $95 million because there were bad debts for 4 Indian PSU banks. Is this a clear and present danger for you as a company? And will the business model mean that you will have these provisions being volatile over the course of the next 3 years?
Okay, so it's good that you raised this point. It's not $95 million, it's 95 million rupees, first of all.
Okay.
So it's
excuse me, yeah, 95 million rupees, yeah.
Yeah, so 95 million rupees, and this is a change in the strategy. When we are looking for monetization and industrialization phase or intellect, we are looking those clients which are not able to enjoy the expertise of intellect and some of the. So it's more of a cleaning up cycle time where this number is coming in. So this number we don't expect to go up or to continue.
All right. So on an aggregate basis, what would your provision rate be? Will it be this $10-20 million only?
Rupees.
That's right.
Sorry,
right.
rupees.
Typically, we provide 2 million rupees. We provide 20 million rupees. We provide 2 crore. We provide every quarter, and that's continuing from last almost 12 quarters. And those are sufficient for us to manage.
All right. Let's shift focus in terms of your deal pipeline and focus areas for you. You've signed large deals in the UK and the largest ever deal with a Singapore-based bank in the quarter gone by. How are you expecting to gain traction, and which geography are you focusing on more?
I think there's a huge scope of digital and contextual. So our position of investment was to make enterprise solutions for the banking, which are completely digital, microservices-based, AI-based solutions. And there's a huge market where legacy modernization is required. So a lot of banks in Europe, advanced market, have not invested sufficient money. After 2008-2009 crisis, they stopped investing in technologies, and they are lagging behind a lot of Asian counterparts. And that's where the significant amount of money is getting invested. So that's a focus area which is we are looking at it. That advanced market now is 62%, because advanced market comes with a higher margin and longevity of the deal and the higher pricing. So all the three factors gets. So Singapore, UK, Canada, Australia. We won 2 deals in Australia last quarter, and then US. And then after that, we are going to Spain and some of the Nordic countries where we are looking our focus at.
All right, Mr. Jain, we'll leave it at that. Thank you very much for joining us. Appreciate you taking out the time and highlighting, your future trajectory in terms of growth and what exactly lies the potential for the company.